Hello, everyone, and welcome to this Edison interview between myself, Elliot Burstock at Edison Group, and Andy Brough, head of the Pan-European Small and Midcap team at Schroders. Today is the 4th of June 2020, and I'm very much looking forward to be discussing a number of topics with Andy. Following a brief introduction, we'll be getting his thoughts on the economy and equity markets. Then we'll discuss Andy's performance and gain some insight into his stock selection strategy. Before we do that, Andy, it's a pleasure to be interviewing you. I hope you're well. And how have you found working from home during this period?
Well, it's been interesting, isn't it? And I've finally cracked and I've returned to the office this week. Cycling in, social distancing is very easy on a floor which used to have about 600 people on where there's 9. And it's just nice to sit in a comfy chair again.
Sure. And many of our listeners will be familiar with you. And personally for me, when I started my career some 10 years ago, you were the first investor I called. I offered you a meeting with a company called Avon Rubber, which I'm delighted to see that you're still a shareholder of. But for those listeners who may not be familiar with you, are you okay just to describe some of the funds you manage at Schroders?
Yeah. So I joined Schroders in 1987 as a chartered accountant from Pricewaterhouse. Spent 18 months as an analyst doing about 5 sectors, and then took over management of the small company team at the end of 1988, and I've still run that fund to this day, 126 quarters later. And then we launched the Midcap fund in November sort of 99, quite good timing. And we've got quite a few segregated accounts as well. So in total on the desk in UK mid and small cap, we've probably got circa £3.5 billion.
Great. And you mentioned that 30 plus years career as a fund manager. Have you been surprised at how equity markets have recovered since the April lows? And do you think there's a disconnect now between the real economy and equity markets at the moment?
Well, first of all, you've got to remember what the purpose of the stock market is, and that is to inflict the maximum amount of pain on the maximum amount of people, the maximum amount of time. And I think this year, it's certainly lived up to that name. And I'm sitting here scratching my head on some of the price moves we've seen. People are pricing in recovery is going to happen. We're all going to be back on planes. We're all going to be on, back on trains, looking at the price of shares of the train line. We're never going to be buying cars again, looking at the price of things like Lookers and Pendragon and Inchcape. And there's a real disconnect, I think, between not just the economy and the stock market, but if you like, from what people perceive as the new companies against the old companies. And it's quite interesting, isn't it? You mentioned Avon Rubber 10 years ago. 10 years ago, you couldn't give Avon Rubber away. They used to be in the tyre business. Well, hello, it's quite hard to compete against the likes of Michelin and those sort of companies. And the company had to sort of reinvent itself into masks and build up its dairy products. And the share price has gone from sort of £5 to where we are today, £33, because everyone perceives that actually it's a new glamour stock. They can't really believe that it was a real mishmash of industrial businesses that needed sorting out. And I just feel that the gap between so-called value and so-called growth has just become too great. And then you overlay that with what's been happening in the retail punters. You only have to look at IG's trading statement today to see record volumes. And talking to my 27-year-old, he said his mates were opening dealing accounts all over the place because there's no football to bet on. And isn't the stock market just a one-way bet that it always goes up? And you just look at the market caps of some of these loss-making companies, and you just scratch your head and think, am I too old for this game?
Interesting. And you mentioned the gap between value and growth stocks, and I guess the liquidity rally that we've seen. Do you think that the governments have been right in this huge stimulus packages and slashing interest rates?
Well, you know, governments have decided that because, you know, no limit in terms of pricing to put on the price of life. You know, I'm not going to debate that here. And, you know, just the huge amount of money that's been thrown at the economy is, okay, it's necessary to keep unemployment at bay for a while. But you can see unemployment sort of appearing everywhere. Now, I was queuing last night outside my local fish and chip shop in Muswell Hill, obviously socially distancing, and thinking, I'm not sure this business model is going to work, where someone comes out and takes your order, you pay at the door, and then you go to the other side and wait for it to be delivered. And I was talking to a few people in the queue, and 3 of them had just lost their jobs. One was in film, you know, two others in the service industry. And then you sort of look across the street and you think, yeah, when I was at primary school, you know, one of the tasks given was to sort of map all the shops in the local town. And I thought, if you did it now and then compared it what's going to look like in a year's time, how many of these things are going to be here? And so I don't think the market's really factored in the potential impact of unemployment. Now, you could argue, actually, well, furloughing's kind of given us a step down, but the next step is companies saying, actually, you know, we're going to lay people off. You know, restaurant group, 120 restaurants never coming back, announced yesterday. Rolls-Royce laying off people, Aston Martin today. It's going to be endless, and that, you know, is going to be a big impact on consumer spending coming back. So yeah, I think it would be a disconnect. And the other thing that worries me is, you know, in my 126 quarters of running money, rent was never an optional payment. You know, everyone paid their rent on the due date. You know, I grew up playing Monopoly. You landed on a square, you knew what the rent was, and then you could work out what the value of the property was. Well, if that's going to change because people aren't paying their rents, what does that mean for the value of property? How does it impact the whole banking system? The trouble with this COVID-19 is every sector is demonstrating how related they are to each other, which is causing a big problem.
Yeah, and you mentioned the problems and sort of scratching your head sometimes looking at the valuations of certain stocks. Do you think we're in for a period of deflation or inflation going forward?
Well, that's a good question. I think in terms of food, we're probably in for a period of inflation. In terms of, you know, I must have another outfit, we're probably in for a period of deflation. You know, what working at home has kind of made people realise is actually they might be spending their money in a different way. You know, rather than having all these outfits for the office in terms of suits, they're probably saying, well, actually, you know, I'd probably much rather have an extension or whatever. So I think we're going to go back to growth in certain areas, like construction and buildings, and other areas such as retail, I would have thought would be slower to come out of it. In addition, you can see the government doing a couple of schemes. You know, they'll probably extend Help to Buy, which might help the house builders, and you can see them bringing in a sort of scrappage scheme for old cars, which then might, you know, revitalise the car market or hasten the move to electric or hybrid vehicles.
Yeah, and Andy, just on your investment framework and stock selection strategy, you use the ABC triangle, and I guess in that B section where you trade lots of stocks, are you seeing even more opportunities in this period?
Well, you're taking advantage of sort of placings, aren't you? Things like Wetherspoons and Dark Group, which they've seen big capacity go out of their industries. If people decide to go to the pub or travel again, then they'll be the main beneficiaries. But it's just interesting how things sort of develop, on this ABC triangle. And A's for us very much demand exceeds supply, and C's supply exceeds demand. So if I give you a sort of example over time, then when I started at Schroders, one of the sectors I analysed was the media sector. And at the time, regional newspapers were stock market darlings. Johnson Press, remember the 250, because they had a monopoly over their local area. And all they did was put their prices up each year. They had no competition. And then suddenly, they decided to attack each other with free newspapers, which we all used to deliver after school, anyway, to the first 10 houses, and then throw the rest in a ditch somewhere. And then suddenly Rightmove came away and all the property advertising went to them. And then Auto Trader came along and all the cars moved offline. And then LinkedIn appeared and all the jobs disappeared. And so that is a sector that's kind of gone ABC and then gone bust. And so as an investor, you've really got to be aware of the ongoing threats. When we were kids, ITV was a license to print money because there were only 3 and then 4 channels. One thing being locked up at home has taught you is that there's really nothing to watch on ITV, and Money Heist, The Last Dance, Ozark, and many other things on Netflix are far more attractive. So that market's probably never coming back either.
Yeah. And you mentioned, fundraising opportunities. Are you expecting more of your holdings to make cash calls? And what do you look for when supporting management teams where you're a holder?
Okay, so it was quite an interesting discussion with Andrew Bailey in the banking sector last night, or yesterday, where the bank said, look, Bailey, this is an equity problem. It's not a debt problem. There's no point giving these people more debt. We've got to give them some equity. So what do we look for? We look for, has the company raised money in the past? So for Wetherspoons and Dark Group to come to the stock market where the founders have big equity holdings, it's like pulling teeth for them. So that's normally a good sign. If management are putting in a big chunk of money, so when IWG came to the market, Mark Dixon put in the best part of 90-odd million quid. I'd rather be investing with people like that. And we're steering clear where we think the discount, the shares being offered at, is too small, or we haven't got a line of sight onto what might happen to that particular industry. So you can say, why have you done Wetherspoons? Well, Tim Martin, he's the founder, he's still at 30%. Okay, the pubs haven't opened, but they've got a plan when it happens. We didn't do National Express because actually we're not sure how many people are going to go back on public transport. I think more people go to the pub than they will go on public transport.
Yeah, and over this period, have you become more focused on balance sheet strength, and what's the overall resilience of the holdings in your portfolio?
The trouble is, you can stress test the balance sheet, but you can't really stress test it for zero revenue. So you have to say what's happening to the competition, how much leverage have people got going into this, will they come out the other side? So a lot of the companies owned by private equity don't have the luxury of turning up to the equity market to raise money, do they?
Yeah.
So the quoted companies might benefit from a lot of the unquoted actually going out of business.
Interesting. And I guess the hope is that your holdings in that A category will continue to take market share.
Yeah, that's the hope. Yeah.
Okay. And you mentioned a couple of stocks that you hold. Are you okay to give some examples that really illustrate that category A that you hold?
Yeah. So in terms of sort of A companies that we've held in the past, things like Auto Trader and Rightmove are holders in the past. Companies that are able to put their prices up each year. I'd probably argue that Telecom Plus is probably in that A category now, as more people look to for other sources of income. And really, A stock for us is demand exceeds supply for your product. Have you got a strong market position? Can you put your price up? Are you unlikely yourself to be disintermediated? Is the key sort of thing. Our job is to really get companies from the small cap into the 250, benefit the small company fund on the way, and then for the 250 fund to get them to the FTSE 100, and then the job's done.
Yeah. And
so this time around, you've got things like HomeServe going into the FTSE 100. That's come up from the small companies. We've held it all the way. And that's what we're trying to do, is to grow with the companies as they go through the indices, and try and avoid those ones which are going the other way.
Sure. And I suppose since launch, the Midcap Fund has been the best performing UK equity investment trust in the AIC UK all companies sector. What's the performance been like more recently?
First quarter, 4% behind the index. Second quarter, so far, 5% ahead of the index. The volatility is just, I've given up looking on a daily basis or even a weekly basis, because you're just seeing such huge swings in pricing. And it's just amazing. Looking at the price move since the 31st of March. They've been massive.
Yeah. And the UK Midcap Fund has got a great dividend track record. Have you built up some good reserves over the years?
We've got about 8 months reserves. This is it'd be interesting to see what the board decide to do. Because companies, a bit like rent, decided that dividends are a sort of optional payment, aren't they? So I think what a lot of companies will do is to take advantage of this pandemic to rebase their dividends to a much lower level, giving them a higher cover and enabling them to have more cash on the balance sheet. So I think for the market as a whole, last year, the dividends paid out were £104 billion. I don't believe that number will be reached in the next 10 years. So you're going to have to be in companies that are either very cheap relative to their asset value and are paying down debt, and you're increasing the equity value that way, or the old company which is capable of growing its dividends at sort of 10% a year.
Yeah.
So even companies that have never cut their dividends, like James Fisher, have deferred it. 25 years of sort of 10% dividend increase gives you some idea of the scale of this thing.
Yeah. And I suppose just changing tack slightly, are you a supporter of primary bid and the participation of retail investors in fundraisers? And what would your message be to companies and how they interact with retail investors?
Okay, I've done a lot for primary bid. I've done webinars, I've signed letters, I've spoken to people about it because I'm passionate that the retail punter should be involved in the market. When I started, they were big stagging. They could get involved in new issues, etc., etc. They were treated on a level playing field with the institutions. And then the FCA have ruled that there's a high risk with these people. Well, the stock market is high risk, even for institutions. So I'm absolutely delighted that primary bid have got the retail punter back, and I'm really hoping that now extends to flotations as well.
Great. No, that's really good to hear. I guess just looking at UK equities, they've underperformed other regions in the first quarter. What's your outlook for sterling and for UK equities versus other regions?
Right. I mean, one of the reasons they underperformed is because we haven't got Google, Facebook, Netflix, Microsoft lookalikes in the UK, have we? Let's be honest. So what's my outlook for sterling? I think sterling's, before this, the UK was in a pretty good space. You know, my portfolios were set up to benefit from increasing consumer spending. Unemployment was at an all-time low. Wages were exceeding inflation in terms of growth. And now we're going to have to sort of look at it and think, well, actually, what's going to happen next? I'll probably be more positive about sterling because I think, you know, the UK has demonstrated over the years that it's been more resilient. And the stimulus that the government's probably going to throw at the economy should lead to sort of faster growth.
Yeah, and I think you famously mentioned that investors need to know when to sell stocks. I guess some would argue that it's just purely, you know, valuations and looking at the growth opportunities. Can you elaborate a little bit more on what you look for when actually selling out of equities?
Yeah, because no one teaches you how to sell a share. Everyone in this game is brought up to buy shares. So, you know, I'll give you an example. So when Conviviality Retail was quoted, we were its largest shareholder, Quid. We started doing a lot of deals. I'm an accountant by training. I pieced the accounts together and we sold a lot at £2.50. Shares went to £4. My team were looking at me thinking, oh dear. And then the company went bust, didn't it? So we will spend just checking that actually the quality of accounting is such that you can believe the numbers that the companies are declaring.
Yeah.
So looking at accounts, obviously if they get into the FTSE 100, you know, a good example would be Sports Direct, closed at £3. We bought 10% of the company, an average of £1.20, and it went into the FTSE at £8.50, and here we are at £3.
Yeah.
So, you know, we don't get them all right, but it's a case of just making sure that you can be confident that the numbers the company are reporting actually stack up with the cash balance at the end of the year, et cetera, et cetera.
Yeah. And over your career, Andy, have you seen more examples of discrepancies there?
Oh yeah, I mean, the quality of accounting at the London market is probably an all-time low, if I'm honest. I mean, the difference between underlying earnings and statutory earnings has never been so big. And for those people who don't know the difference, underlying earnings is what you have when you exclude all the one-offs, exceptional items, share option pay, et cetera, and statutory earnings are what you have when you've included them. Needless to say, most companies focus on underlying earnings.
Yeah, and is that a regulatory issue, an auditing issue, or just an educational issue?
I think if I'm honest, I think it's an educational issue because, you know, people forget what auditors do, right? Auditors don't actually break in and rifle through filing cabinets in the middle of the night with a torch. Yeah, what they do is they audit the information given to them by the management. So if the management don't give them the right information, there's not a lot they can do. So if you take autonomy, they were auditing the information given to them by the management. HP bought the business, and then it was bust the next day, wasn't it? So
yeah. And then I guess just moving on to, you see a huge amount of management teams. What's been their attitude to leverage over the last sort of 10 years to now? And then I suppose what's the cash position of your Midcap trust and the gearing of your trust as well?
The gearing of the trust is about 4%. Yeah, we went into this crisis with gearing. In hindsight, that was a mistake, but what we did was actually sweat it out. So, you know, when the thing went down, we didn't panic. When it went back up, we still had the gearing in place which has gone to a higher level because the shares have gone down. Anyway, gearing, so management teams are now saying net debt to EBITDA is, should be between 1 and 1.5 as opposed to 2 and 2.5. And I think there's going to be no pressure from investors for companies to gear up and pay special dividends. It's quite interesting. One of our large holdings is Games Workshop, which in their report and accounts states that dividends will only be paid out of truly surplus cash flow, which is quite interesting.
Yeah, definitely. Yeah, well, it's a highly cash generative business, and it's got good global diversity. It's actually an Edison research client as well. So yeah, no, we're definitely a fan of that company. And just looking at the UK Midcap Fund, the trust is trading at about a 12% discount to NAV. How does that stack up historically? And is there anything that you'd like to say to our listeners in regard to looking at the UK company sector?
So the discount kind of fluctuates between 5 and 20. I tend to buy them personally at 20. I hold, personally, the Brough family holds just under 2% of the equity in the Midcap Trust. So on the basis that that's apart from my Schroder shares, that's my largest PA holding, and because I believe that if the price goes up, we all win. If the price goes down, we all suffer, and that is the way I look at it. The board fluctuates. I had the odd go with share buybacks, but I don't think they really work. So I just use myself as a sort of my own discount control mechanism.
Sure. And you mentioned that you've got skin in the game, obviously. How important is that to you when looking at companies to invest in?
I think it's very important because actually, if you look at JD Wetherspoon, they don't really have exceptional items. If you look at Dart, the same really, because management recognise that, statutory earnings are what they should be looking at rather than underlying earnings.
Great. Fantastic. Well, that concludes our interview. There was a lot to get through. I'm conscious we chopped and changed topics at various times, but I hope everyone found that very interesting. That just leaves me to say thank you, Andy Brough, head of the Pan-European Small and Mid-Cap team at Schroders.